The S&P 500 posted its best single session since last May, and the ASX 200 staged its strongest two-day run in months, while the Strait of Hormuz remained almost entirely closed to commercial traffic. That gap between equity markets and the physical oil market defined every session this week. Brent crude swung from $107 to briefly below $100, then spiked back above $109 after a single speech, a range driven entirely by Trump's shifting statements, rather than any change in the underlying supply disruption. The Strait, which carries roughly 1/5 of the world's daily oil and gas, has seen vessel traffic fall from over 100 ships per day to fewer than 5. The oil market priced the physical reality. Equity markets priced the diplomatic rumor. The week ended with both narratives still unresolved, Brent holding above $105 and the Dow down sharply in after-hours trading after Trump pledged escalation rather than exit. The Hormuz Trap. The physical oil market and the futures market diverged in a way not seen since 2008. Brent futures closed near $109, but spot prices for barrels delivered within 30 days hit $141, a $32 spread that tells you everything about where actual supply stands versus where markets hope it will go. The Hormuz closure is now 5 weeks old. Of the 23 direct attacks on commercial vessels since the conflict began on February 28, 11 crew members have been killed, and what remains of shipping traffic is dominated by sanctioned tankers vetted by Tehran. Britain's foreign secretary described it as a hijack of the global economy. A coalition of more than 40 nations met virtually this week to discuss how to reopen a strait that no country is willing to force open, while Iranian anti-ship missiles and drones remain active. TD Securities estimates nearly 1 billion barrels will be lost by end of April, 600 million barrels of crude and 350 million of refined products. Every additional month adds another 450 million combined barrels to that deficit. Onshore inventories could fall to multi-year lows as early as August. That timeline is what the futures market has not yet fully priced. The policy trap. The Hormuz closure handed the Reserve Bank and the Federal Reserve the same impossible problem through different transmission channels. For the RBA, Brent above $100 has pushed Treasury inflation modeling to a 5% peak, forcing 2 consecutive rate hikes already, and Westpac now projects 3 more by August, taking the cash rate to 4.85%, a level not reached since the global financial crisis. The fuel excise cut Canberra announced this week compounded the difficulty. Fiscal stimulus added demand pressure at the precise moment the RBA is trying to remove it. Former Treasury Secretary Martin Parkinson put the tension plainly, warning that spending without savings offsets directly undermines the central bank's inflation fight. In the United States, the problem runs the other direction. Fed Chair Powell acknowledged this week that the Fed's tools have no meaningful effect on supply shocks, and that tightening into an oil-driven slowdown would hit the economy at exactly the wrong moment. Bond markets responded. Rate hike probabilities collapsed from above 50% earlier in the month to near zero after Powell's Harvard remarks, then reversed back toward 45% by Thursday as oil crossed 110 again. Bank of America now projects headline PCE inflation surging to nearly 4% this quarter, against the Fed's own estimate of 2.7%. The 30-year mortgage rate hit 6.46%. Neither central bank has a clean move available. The RBA faces stagflation pressure from an economy already slowing under rate hikes. The Fed faces an inflation trajectory it cannot target without triggering the recession it is trying to avoid. Trump's signal problem. The week's equity volatility was not driven by data. It was driven by the gap between what Trump said on consecutive days and what the oil market believed. On Tuesday and Wednesday, reports emerged that Trump was willing to end U.S. involvement even without reopening the strait, and that Iran's president had signaled openness to a deal with guarantees. Both the S&P 500 and ASX 200 surged on those signals, the S&P posting its best session since last May, the ASX staging its strongest two-day run in months. JP Morgan and Goldman Sachs identified the driver. Hedge funds had built their largest short book since 2022, and the ceasefire rumors triggered forced covering across miners, banks, and technology names simultaneously. Then Thursday arrived. Trump pledged to bomb Iran's power plants, promised to destroy its power grid, and declared the U.S. would finish the job. The ASX 200 shed 1.4% in 90 minutes. Brent spiked back above $105. Dow futures dropped more than 600 points in after-hours trading after Wednesday's evening address. The mechanism behind every swing was identical, a repricing of how long the Hormuz closure would last. And at the end of the week, the strait remained exactly as closed as it had been on Monday. JP Morgan strategist Marko Kolanovic warned the rallies look more like traps than genuine de-escalation, and the physical oil market validated that read each time.
Real economy damage, what began as a petrol price shock, has now embedded itself in the cost structure of ordinary commerce. In the United States, gas station spending surged 21% year-over-year in the week ending March 28th, while furniture and department store sales fell every single day of that same week. Consumer sentiment collapsed to 58.4, a level last seen during the 2008 financial crisis. The Hormuz closure disrupts more than crude. diesel is up roughly 70% more than gasoline, polyethylene is up 30%, and fertilizer feedstocks move through the same strait. Dow CEO warned petrochemical shortages could fuel inflation through year-end. The K-shaped impact is direct. The wealthiest 10% of Americans already account for nearly half of all consumer spending, while low- and middle-income households, who spend a larger share of income on essentials, are running near historic low savings rates with no buffer. In Australia, the damage has become operational. 3 major logistics carriers imposed surcharges between 22.7% and 36.5% this week. Australia's largest prawn operator collapsed, cutting 200 jobs. Food relief organizations reported families choosing between fuel and meals. Western Australia declared a state of emergency over supply. The government responded with a $1 billion package, including interest-free small business loans and a fuel excise cut. But economists note the surcharges, once imposed, tend to become permanent price rises if oil remains elevated through April. The energy transition shift. The investment thesis for renewable energy shifted in character this week. IRENA reported that renewables now make up 49.4% of the world's total energy capacity and accounted for 85.6% of all new capacity installed globally in 2025, numbers built before the Iran war began. What the Hormuz closure added was a second engine entirely separate from climate policy. Southeast Asian governments facing physical fuel shortages are fast-tracking electrification as a supply security measure. European households are accelerating solar and heat pump installations to reduce dependence on disrupted import routes. IRENA's Director General stated directly that countries that invested in energy transition are weathering this crisis with less economic damage. GE, Vernova, and First Solar emerged as the week's primary beneficiaries of institutional rotation out of oil-exposed positions. In Australia, the structural pivot was visible in policy as well as markets. Parliament passed legislation allowing strategic stockpiling of fuel alongside rare earth minerals, treating energy reserves as national security assets. Export Finance Australia took a $100 million equity stake in Arafura Rare Earths, pushing total government backing to $1.2 billion for the Nolans project. The reframing from climate argument to national security argument is significant. It opens the energy transition to political constituencies that previously opposed it, including those aligned with the Trump administration's energy independence priorities. The week's central fact is structural. A physical constraint, near-zero vessel traffic through the Strait of Hormuz, drove every market move, while diplomacy produced noise rather than resolution. The weight of evidence leans toward continued oil pressure through at least mid-April. Iran has captured an estimated $500 billion in windfall revenue from elevated prices, which gives Tehran limited incentive to negotiate quickly. TD Securities barrel math shows physical inventories on a trajectory toward multi-year lows by August, even accounting for emergency stockpile releases. The 40-nation coalition pressing for Hormuz access has not yet produced a concrete shipping agreement. The critical variable for next week is whether Trump's escalation language from Thursday hardens into a formal military expansion or softens into renewed diplomatic framing. If Brent holds above $110 through Wednesday, the Bank of America inflation forecast, nearly 4% PCE this quarter, moves from projection to baseline, and markets face the scenario where the Fed's hold-and-watch posture becomes increasingly untenable. The April 10 CPI print then becomes the week's Vulcan. A reading above 3.5% would delay rate cuts further and compress growth stock valuations for another leg down. That is the downside path. The recovery scenario is specific and requires 2 concurrent moves. A verified diplomatic signal, not a Trump statement, but a multilateral framework with a Hormuz access timeline, paired with Brent sustaining below 100. If both materialize before mid-April, the inflation trajectory shifts, rate expectations reset, and the short covering rally seen Tuesday and Wednesday would have genuine structural support rather than fragile positioning. Neither condition was in place at the end of this week. The tension introduced in Monday's session between equity markets pricing resolution and the physical oil market pricing duration remained entirely unresolved by Friday's close.